Now, for the capital story. Are investors getting more bang for their buck? This is what the next panel will be discussing threadbare. Why don't we let them tell us? Let me first begin by introducing our moderator for this panel. He's the Managing Director and Co-Head Capital Markets India, CBRE South Asia Private Limited, Mr. Gaurav Kumar, MR, ICS. Welcome, sir. And now for our panelists, who our moderator has the job of posing the questions to. You just met him. He was the moderator for the first panel. Please welcome once again Mr. Sunil Agarwal, FRICS, Associate Dean and Director, School of Real Estate, RICS School of Built Environment, Amity University. Joining them as the second member of this panel, we have the Head of India, Real Estate Principal Finance, Standard Chartered Bank, Mr. Ashish Singh. Joining the others, we have the Managing Director, Valuations and Advisory India, Cushman and Wakefield, Mr. Somi Thomas, MR, ICS. And filling up the final chair of this panel, we have the Managing Director, Descon Ventures Real Estate Services Private Limited, Mr. Sarang Kulkarni. I now hand the floor over to our moderator, who will take us through the next 50 minutes.
Sure. Hi. Very, very good afternoon, ladies and gentlemen. It's been a power-packed year, 2016. Lots has happened. RERA's come in, GST is coming in, loads of new policies, affordable housing. Hopefully, GST should also kick in this year. 2016, by our internal estimates, saw about $6 billion of capital infusion in real estate. And we expect that number to go up. And I think our research team is fairly conservative in the way they assess capital movement. So this year, the outlook is $7 billion, but I'm sure it's going to be a lot higher. As the markets have evolved over the last 7 or 8 years, and it's impacted the quality of capital. 5 or 6 years back, I think the quality of capital, especially from a developer's perspective, did deteriorate considerably. And now we feel a lot of positive trends from long-term institutional investors, so-called patient capital coming into the market, something like what happened in 2005 and 2006. But Ashish, I'd like you to give us a little bit of flavor. I know that there is a big paradox about how there is a slowdown in the Indian real estate economy locally, but there is so much euphoria and so much positive sentiment amongst offshore investors who feel that now the fundamentals of the country are finally getting in place for them to come back again and take a longer term call on Indian real estate. So, if you could share some thoughts with us on that.
Sure. I think that the interest in the Indian market is now at a renewed level. It's at a significantly higher level than any time after the crisis. And like you said, I think it's also sort of in a more positive sense. Now we are at a time where capital is beginning to chase asset creation rather than just asset refinancings, which was the trend for most part after the crisis so far. I think that irrespective of the market cycles with respect to residential or office or other property sectors, I think it has to do very largely with where India is based on its macros. It is also linked to a lot of the reform that we are expecting to see going forward. Although most investors also realize at the same time that there will be some sort of transition period before all these reforms become really effective and streamlined. But for a longer term story, this is great, this is positive. Both RERA, GST being positive reforms that will sort of make the sector more and more institutionalized in time to come. I think it also has to do with the fact that there is a cyclical favor. The cycle is favoring, and I think there are different types of investors who enter the market at different points of time based on what they want to do, what their risk appetite is, and so on and so forth. So we've seen a lot of capital into India, coming into India all this while. But I think that the capital that is coming in now, and I agree with you, would tend to be more sort of long-term, patient, linked to more and more asset creation. Also, I think the fact that we are sitting at a place where, let's say, residential is not performing all that well, there are also investors who would see this as a buying opportunity, perhaps. So like I said, market may be at different points of cycle for different property types, but I think there are investors for all, and I truly believe that for a long-term investor, there are opportunities all around at any point of time in the cycle for any property type.
Before we go into sectoral calls, I'd like to get Shomi and Sarang's views on this whole long-term capital. And we keep talking about patient capital. Developers have, for the last 5 or 6 years, been saying that, look, most of the capital available is structured debt. It's 3 to 4 years. It has no link to a real estate project cycle. I mean, including Bangalore, development approvals could take you 24 months. And if your loan tenures are 3 to 4 years, it's just very, very unfair, and it is debts. Now we see a lot of pension funds, so APG came in, CPPIB, now it's Ivanhoe Cambridge, there's Adya, there's that whole profile of investors changing. Of course, that capital is available to a very small percentage of the developer community. So that is a big factor. But the fact that all of these investors are now looking at India, and so you'll probably in touch with a lot more. What is your view on their sentiments? Are they now, willing to convert their interest into actual real funding transactions, or are they still sitting on the sidelines saying maybe there's a still a little bit more asset valuation correction that needs to take place, like Ashish said? Maybe they feel there's a little bit more pain to go through.
No, I think it's a valid point, what Ashish said. A lot more renewed interest in India. But one of the things, just to quote from an investor 2 weeks ago whom I met, they were in India in 2006-7 days, haven't made much investments, they are now entered back. So there is more interest. People who could not make investments in the past cycle has come back to India. But one comment he made was, India is getting a second chance. It probably won't get a third.
That's true.
So hopefully this cycle, with the RERA, with the initiatives of the government, this is going through a more structured process where you don't see exuberance building up or excitements leading to irrational supply-demand mismatch. So I think what I see positive signs, why I think this cycle is going to be more fundamental and more long-term sustainable capital creation that's going to be happening for the Indian real estate sector is because of 3 factors. We already see consolidation, and consolidation is good for any industry. And you also have an institutionalization happening. So when you have an institutionalized approach to decision making, you are not playing by the egos, if I may use that, to create the assets. You are looking at what the market wants. Even the previous panel spoke about what the customer wants, you're creating that. Is my product better than the next developer's product or the competing product, or what is required for the market? We can see in various markets, luxury real estate struggling. And why was so much luxury real estate required in the first place? Was it really required? So I think the institutionalization of the market is giving that confidence. Second, the RERA, which will definitely force consolidation among the developers, and that's a trend that we are seeing today. These 2 factors gives a confidence to believe that the investors who are coming in today are looking at more long-term approach, and it will be more fundamentally driven, and we will not go to that cycle so fast. So I think that's the confidence that we get.
Yeah, I think just to add to Ashish and Somi, what happened in the previous cycle was everyone was looking at just the opportunity to be in India. Now the opportunity has still not changed, but what has changed is the regulations, the transparency that is promised in real estate. So that is inviting more the bigger investors to come into India. Now, obviously, everyone is looking at an exit mode also, which is something going to be like a REIT. Now, to nurture a REIT, what you need to also have is quality assets. So that's what everyone is looking at. All the big funds are looking at quality assets now. They're going after the good developers. All the good developers have big funding from these institutional investors. And I think the overall asset quality is going to improve. Now, with the REITs or the REIT approach, what is very important is your leasability, the leasability of the space. REITs have to function, if they are efficient, they have to go up to 95%, 96% occupancy. To achieve that, it is only possible if you have good quality assets at good locations. So that is what everyone is aiming at this time.
You know, Sunil, I want to bring you in here and ask you a real question. Do you feel that genuinely now real estate players in India are looking to institutionalize? Are they looking at corporate governance? And I know RICS plays a big role there because that's one of the founding principles, you know, quality, transparency, standardization. Is this more lip service because you want to show to the investor community that, look, you know, we're now suddenly our whole way of doing business has changed? Or is there a genuine desire where they feel that the business will add a lot more value if it is more structured, you know, like a lot of other industries are?
So let me take you through two instances that have happened in RICS. There are two small-time developers, one out of Surat, the other out of Sri Lanka, who've come themselves and said, we are sick and tired of the way that we are doing business. Our fathers did it in certain principles, but we want to run a much more structured business. And one of them has actually sort of engaged some of our faculty to guide him to put a structured business. So I think I am not seeing this as a general line of thought, but I'm seeing that yes, there are certain developers who are willing to put a structured business. They don't want to be living out of, you know, a fear that somebody is going to catch me. So whether it's income tax, whether it is some kind of a regulation that I have flouted and then I am chasing courts, etc. So I think there is a small percentage of those guys who really genuinely want to change. On the flip side, I was in Bombay trying to do a valuation, you know, exercise for a very large auction that is supposed to hit the market, and I was trying to figure out, has the fungible FSI really improved the situation, and is the transaction really on a certain area which you calculate on paper by the law? And you know, I can't write it in a report, but the funny part was that everybody I went to said, this is going to be at least 2.1 million, this 14 lakhs doesn't look right. So we are going to add some in some other way. So I then tried to do a valuation still on the carpet area. I'm talking big names, I'm talking of everybody in the game. So I think there is still that tendency that if I can, I will still want to sell on a area which is absolutely not there, doesn't exist. And I will have hundreds of reasons why I will do it. So I think the governance is setting in not because there is an intrinsic desire at large to be structured. The intrinsic desire, and there's a reason why that is so. It's because even when RERA came in and has come in, now obviously we are in a post-RERA stage, the amount of trouble that one gets into when you apply for permissions, as yourself said, Gaurav, the amount of regulation that I have to comply with in this industry, the amount of pain that I go through, at some stage if I'm a developer, I will say any which way I need to get much better per square foot price than what I'm getting in. And therefore all this jugglery, you know, happens. Sure. I think what's going to happen is because now you have a regulation and you can't do it in a certain manner that you were already used to, by default you will fall into governance. By default you will have to be governance compliant, otherwise you will not attract private equity, you will not have decent funding, you will not have even customers because they're going to question. So I think it's the law which is going to bring the change. But yes, I see a very small percentage of developers from the newer generation who really want to make that difference, and that is also, so it's a mixed kind of a
I think the
thing.
last point you made is a very important point, and while we don't want to make this a panel on corporate governance, but ultimately the link directly is between attracting long-term quality investors, and they will come in as they feel more and more comfortable with the Indian environment. Sectoral calls, Ashish, you're someone who's actually invested historically pure pari passu equity into greenfield residential developments when everyone else was doing structured debt. Now you have a platform to do office development again, and maybe some quasi brownfield core assets, and you've set up a platform for affordable housing. So you've really seen all three sectors evolve. And now everyone says office is the new residential. So 5 or 6 years back, all the focus was on residential, which has now shifted completely to the office segment. So I wanted to get your views quickly in terms of how you see these three sectors panning out.
I'll pick the easier first. The affordable housing story for India is a very strong story, I believe. The reason simply is that as you go down the pyramid, the potential market to address is much wider, much bigger. However, that comes with a few challenges. I think the affordable housing word also it means different things to different people. So it's very important for me to sort of say here that I look at affordable housing as like what we're doing is really urban affordable housing, and it's for that customer in the market who is bankable but priced out of the market in terms of ticket size. And that may be a very different sort of meaning of affordable housing from most other people. And the reason why we consciously decided to be in this segment is because we see that there is a huge delta in terms of demand supply in this segment itself. And this is a segment where you can build and deliver an institutionalized product, and you're not necessarily dependent to do that. You're not necessarily dependent on government incentives. And I think most investors would believe that if a product is self-sustaining based on the demand supply and demand-based pricing in the market, then that's a long-term business to do. So that's what we've started with. At some point in time, we may migrate to other segments of affordable housing as well, but that does very well. Another thing to point out about this is that in the Indian market, especially in residential, I have seen the biggest killer or biggest drag on investment returns are the delays. And these delays start happening right from land acquisition to design and development and permits. And the biggest variable here being the time frame for permits. And sometimes the permits get delayed for reasons that are difficult to believe can be the reasons for a drag on investment. So that's the part that kills the investment returns in most cases. The office cycle has been pretty robust. We came out of I think a very long period of oversupply in the pre-crisis time because people wanted to maximize the valuation for their land. They thought that office use was the highest and best use, and it probably was given where the rents were expected to go and so on and so forth. So a lot of them started building offices. That built a huge wall of oversupply, which got exhausted, I think, in 2013 or 14, sometime around that. And as a result, as that oversupply went away from the market and demand started picking up in the post-crisis years, we've now seen a turn of the cycle where pricing power is coming back in the hands of landlords, and hence we've seen some real serious rental recovery as well. In the longer run, however, most investors would believe that the sort of demand-supply based mismatches will only drive pricing in the shorter run. In the longer run, you will pass on inflation or maybe some just above inflation to the market, provided the demand stays robust. So that's where we are in the office market cycle. I also agree to the point that absorption of a lot of investment is also a function of how much quality stock we have, assets we have in the market to absorb. And that I see potentially as a challenge for the Indian market at some point of time unless we build for the future. The third is really the middle class residential story. That market, that segment has performed very poorly over the last 4 or 5 years, despite the fact that office demand has been picking up. The residential market, middle class residential market has performed worse and worse over the last 5 years, or 4 years or thereabout. And I think that has to do with a lot of oversupply that happened in the post-crisis years and through the crisis years. It has also happened because the prices went up a lot faster than the market could sustain. So that has to change. And perhaps we are also in the market at a tipping point where people are no more buying predominantly their first homes. So what's happened is that market is coming out of a very long period of undersupply because before liberalization, the creation of housing stock was very minimal, and liberalization created so many jobs and so many new aspirants to buy homes. The average age of buyer of home decreased substantially, perhaps late 30s or 40s to something like early 30s or mid 30s. And that created a huge demand for residential, which we sort of mistook as a permanent demand forever. And that wall of latent demand is now subsiding. And hence we will see more moderate demand, and hence we must see more moderate supply in the market. Another challenge with residential has been that there has been just too many developers in the market, and perhaps sustenance of so many developers would be difficult in time to come, given where the demand and supply cycles would be. So my own expectation is that this market is seeing some consolidation. It will continue to see some consolidation. And I think that only those developers who have a track record in managing and meeting customer expectation will survive in the medium to long run in the residential market. But to summarize, I think returns are there in all of these segments, depending on what kind of risk, where you see. The point that I want to drive is most investors would tend to chase risk-adjusted returns rather than absolute returns. So depending on where the risk is depending on where you are in the market cycle, they will take differential risks for a better risk-adjusted return.
That, very useful perspective. The other thing, just on the last point that you made, is also earlier, all the interest was on core assets, which are fully built, leased office assets, easy to do, no regulatory risk. You don't need to wait for 3 years to get an OC or a building plan approval. And there was a flood of capital in the last 4 or 5 years. But the heartening thing now, and what gives us a lot of confidence, is that increasingly investors like you and a lot of others are looking to take greenfield development risk. For that, to me, is a great green shoot as far as Indian real estate is concerned, because suddenly it means that people believe in the upside. People believe, that bang for buck, they actually believe, whether it's affordable housing or office, that they can genuinely make more returns developing assets. And yes, the key risk always will be local regulatory environment. That we've seen time and again that being a big letdown as far as investor returns are concerned. So, which is why a lot of investors come in and say, look, we want to come into a fully approved project. We have no problems taking in development risk or leasing risk or sales risk, but show us a site which is fully approved. I can actually literally start development today.
Sure. I think that there is appetite for all types of risks in the market, provided those risks can be known and quantifiable. So there is appetite for greenfield risk, and there is still quite a bit of bunch of investors who would like to focus on core and ready properties. But at the same time, I would say that there are enough investors who are willing to bite the development risk, the approval risk, the land purchase risk, and so on and so forth. I believe that the returns have to justify, and on the investor side, they must know and appreciate all the risks. So a lot of the times in the pre-crisis years, people thought that once you buy land, everything will happen like a clockwork. That does not happen. So predicting the right time frames, the risks very well, and pricing the risk well is a very important thing, and you got to be plugged into the local market to be able to do that. And hence,
Ashish, I'm tempted to ask a question. You know, there were these roadshows that were happening in 2006, and you looked at any information memorandum, it said 25% IRR. You know, that was the story. So there was no risk differentiator. Are you seeing now IMs which are saying we'll give you 15, we'll give you 18, which are giving 22, and saying this is the risk we are taking, this is the return we'll give you? Has that story also changed? Because I think a lot of that euphoria you saw was because everybody, whether he was doing office assets or any kind of investment, he said 25% to aayega. And I think that is a story which should, so are you seeing that changing?
absolutely. I think a lot of that has changed. In the pre-crisis years, people made several wrong assumptions. They thought land was money, land valuation was everything. And as against that, today, they are only valued for what they can monetize over the next 5 to 6 years. So anything that you can't monetize over the next 5 to 6 years has no value. It doesn't convert into your P&L. The second thing that they thought wrong was there was infinite demand and infinite ability to execute projects. So there were people saying that we have 100 million square feet under execution, and that is just 100 million square feet is just too much to be under execution at the same time. So that was wrong. And the third thing was that they thought that based on these assumptions, there is a 25 or 30% return possible. Now, it may be possible in unique situations, but most investors are more realistic about what is the return, and they operate in a band. And that's where I think the concept of risk-adjusted return comes in. There are certain developers who are always looking to optimize the cost of funds at the cost of taking more risk, and that's the investor that is going and raising mezzanine type financing and not equity. And there are those investors who see value of equity, who have a very good understanding of what equity risk is, and who don't want to increase risk on their balance sheet. They go and raise straight equity. And there are both types of investors in the market today.
Before we come back to affordable housing, and it's been the buzzword for a while, Somi, I'd like to ask you, as you advise clients and as you value portfolios, on just the regular mid-market residential side, do you see any changes in the way lenders or investors are looking at portfolios? Are they a lot more cautious now, or are we seeing some green shoots? The cost of debt has significantly come down. So structured debt used to be a bad word just about 6 months or 1 year back. But what the interest rate regime has done is it significantly lowered that cost. So it's no longer a 20% IRR. It's about at least 200 to 300 bips better, even for regular developers. And I think that it's a great way of, it makes business more viable. Of course, if you're in certain markets where residential sales are very slow, then it's much more difficult even at those interest rate levels. So what are you seeing from domestic and offshore investors?
I think it's a very valid point, which Ashish also mentioned, that there is a tremendous shift in the way the investors look at projects today. The underwriting assumptions are quite debated. Reasonableness of pricing, is the escalation going to be there at all in the project? What is the velocity? There is a lot of interlinkage between these things. If you assume a price escalation, then your velocity might definitely dip. Or if you don't assume a price escalation, then your velocity can be reasonable. So there is a lot of linkage that is coming in, and a lot of rational approach towards the underwriting assumptions that we see, both domestic as well as international investors. But probably I can share something different from an office space perspective. Some of the early investors in the office market in India, which is a core assets, are today not so gung-ho about greenfield. When I say greenfield, I'm talking about doing a lot of speculative developments. So even to take an example of a Bangalore where you have a very thriving market which has very low vacancy levels. That very low vacancy levels has been achieved because the developers were very, very practical in terms of building the speculative supply. So even the two largest developers in Bangalore, before they started 1 million square feet, even a year ago, they used to wait for a pre-commitment. Pre-commitment need not be for the entire 1 million square feet, but at least for 30% of it, 40% of it. Because of that discipline, we have a single-digit vacancy, or in some micro markets, 2 to 3% vacancy. And that has resulted in rental appreciation. Now, when you look at the market, there is a lot more optimism, rightfully so, because the vacancy levels are very low. So therefore, there's a lot more excitement to build speculative assets. Now, people are seeing that on ground today. And this is, Gaurav, also need to look at the context of India, the zoning regulations. There are certain pockets where you cannot do anything but commercial. In commercial, can you do a retail? Most developers don't want to do a retail. Can you do a hospitality? Still not recovered from the 7-year, 8-year-old cycle that we are going through in hospitality. Then what do? Office space. Office space is doing fabulously well in Bangalore. Now, if you create so much more office space in a market, it's KIDB owned land, and I have invested in 2007, not now, because I'm not buying land anymore. So I am creating more speculative supply, which is being debated in some of the boardrooms of initial investors who have come into core assets. So the excitement levels are not so much for the greenfield speculative development, or if at all they're doing it, they're more reasonable in their assumptions. Just one more point to get into the technicalities. Ashish said about a very interesting observation about land bank that can be monetized in next 3 to 5 years. And in one of the core assets portfolio, when you are discussing with an international investor, there is an undermarket tendency in the market. Today, the market rental is 70, 75. And some of the initial deals are signed at 40 rupees, 45 rupees, which is still today sitting at 50, 55 rupees. So the investors are probably taking a call. Whatever is getting renewed in the next 2 to 3 years, I am giving a higher weightage to re-rate to the market. Anything that is going to happen probably in 2021 or 22, I am not giving that same amount of weightage. So my cap rate analysis or my yield analysis is changing. So that visibility of repricing. So what again leads to everything, it is more sustainable. The markets are not getting over exuberant. There can be certain deals happening at a particular cap rate because of undermarket tendencies in the portfolio. But overall, there is a lot of rational approach, lot of debates on each of the assumptions that goes into this, which shows that the markets are going to be more sustainable as we go through.
Which I guess covers the risk-adjusted returns point that Ashish was making. You know, the other thing that I want to talk about is how it's a very tough time for incumbent investors, but great time for new investors. And we spoke about, you know, I don't want to use the word correction in asset valuations, but even if you look at land, it's a lot easier now to enter into land situations, which is marking the entry of the domestic investor back into real estate. And I think that's a very, very important trend when we talk about bang for the buck. As you are new investors, you could be family offices, you could be Indian corporates. So, you know, even outside the regular Tata, Godrej, Mahindra triangle, there are a lot of Indian corporates who feel that maybe with RERA coming in, although it's a double-edged sword, with RERA coming in and more corporate governance, it's a great time to enter into greenfield, brownfield, completed asset situations, you know, which is what I call consolidation. So Sarang and Sunil would love to get your views on, you know, what you're seeing in the market as far as this is concerned.
I think with, again, the institutionalization of the real estate, what has happened is it has upped the bar on the development that is happening and the expected returns out of the properties. So that has given a lot of confidence into the corporates who want to now invest into the real estate, because they know that the bar has been set and they know what to follow, what are their benchmarks. So I think the family office in that way are looking at the commercial, but then there is also an undercurrent on the other assets classes that are now coming up, which is basically senior housing. Then you have the schools. Then you have the storage spaces, which are yet to pick up in India, but that's another viable model that can come up. And again, when the institutional money comes in, the big money comes in, the exit through all this is REIT. And especially because all these asset classes are not stratified like the core assets, like residential and commercial. which has been happening for small developers, these are the assets that are held by a single entity. And once the asset is held by a single entity, it is much more easier to offload it as a REIT or listing it on a stock exchange.
I think whatever the panel is saying is that people are getting more rational to assessment. From my perspective, there's still that risk of promoter. And you still have this, I don't know how to assess it, but I think it's just the track record. So, as Gaurav, you said, there is a lot of capital, there is a diversification, all these rational assessments are being made, but I think that capital is available to extremely few developers. And we've seen platform deals where, you have GIC and DLF now saying, we'll make another 18 million square feet. And that is something which is on a basis and understanding. So I think it's emerging to be on the international level. I mean, reminded in 2006, there was a company called Lubert Adler, and they said, there is no negotiation on the term sheet. We go with a certain fund because we have now made understanding, here is what we invest, this is what the developer wants, and this is the promote structure. So I think you're going to see a lot of capital which is going to come into the country based on the past performance of the developers. And I think that is again bringing us back to the regulation standpoint that while people are looking at greenfield developments, people are looking at alternate assets, I think, and somebody said you have a second chance, I think the second chance really is that as promoters, as developers, as Indian investors and developers, I think we need to treat this capital with some respect. I am often reminded, times of 2009, 10, 11, 12, you went to any international conference and you were trying to explain, talk sense that this is happening or that is happening, people are not even ready to listen to you. I mean, you just said everybody in the conference would say, I went to India, I lost money. There was no respect for any kind of investment. Very few investors went with a story that I went to India and here is my money, I made decent amount of money. And to counter that argument again, I think we've had very sensible investors. When 2006 the story was happening, I think there were a lot of investors, very sophisticated ones who said, well, it's another market which is opening up to real estate. The first 5-7 years of investment is going to be painful. So we are going to stay away from this. Let that cycle complete. We are not going to jump into this cycle. So what I'm also envisaging is that a lot of players which are of institutional nature, which looked at India from a long perspective, have seen 10 years of market opening and then going through cycles, I think are also going to come in this race.
To me, it's also about demand and supply of capital.
Yes.
And, that dynamic has completely changed now. 6 or 7 years back, it was completely glutted with capital, and now you have fewer takers as far as that is concerned. Of course, the threshold of corporate governance has only evolved over a period of time, and that's typical of an emerging market. So it's a lot better now than it used to be. Some of it is organic, some of it is forced, some of it is regulated. But I want to again come back to the consolidation point. One is about institutional investors, but you're also looking at partnerships and you're looking at platforms, and you said, the so-called promoter risk. But in a way now, a lot of entrepreneurs and promoters are happy to accept or happy to partner, whether it's for technology, whether it's for branding, whether it's for capital. And we see a lot of platform level partnerships take place even with, if you look at outside the top 5 or 10% of the development community in India, a lot of the other developers are now more receptive, saying, look, maybe, we want to look for XYZ kind of partnerships. And it may not be restricted to capital alone. It could be a lot of other things. It could be branding. It could be the ability to develop, execute, sell, which I think is very, very important as far as the maturity of the industry is concerned. And the second point I want to reiterate is the coming back of the HNI or the family office. Because remember, the only asset class that has made serious money in India over the last 20 years is actually the local investor. He's always understood the risks. He's appreciated the risk-return trade-off better than everyone else. And he is, frankly speaking, the most, he's a vintage investor. He's been around longer than any of us has been. And as they come back, I feel that's again something one can capitalize on from a supply perspective. A lot of the supply monetization will get eased off by these investors coming back in. Finally, what I want to ask Ashish is that as markets evolve, and as we see our Asian counterparts, our Western counterparts, it's all about trading of assets. Maybe India and China are two exceptions where you think of development, you think of townships, you think of mixed use, because there's so much value to be still created. With the coming in of REITs, institutionalization, and all the good things that are happening, do you feel, and of course a strengthening of debt markets, I feel now with interest rates coming down, and you have the banking sector, you have the non-banking sector, you have the AIF sector, I feel our debt markets are a lot more deeper than they used to be 6 or 7 years back. Do you feel we are slowly moving towards resembling our Asian counterparts in the way real estate markets operate there?
Yeah, in terms of financing markets, yes. In terms of development, I think that China's scale is very different. And so far, if our assumption is that Indian real estate market will depend on private capital a lot for development over the next 8 to 10 years, then I think very large format developments are perhaps an area which will see less money, which will attract less money. And the reason is not because the capital is not available for 8 to 10 year or 12-year type of tenure. I think the reason is that in the Indian context, the risks grow many-fold. The cyclical risks of hitting much more than one or more than one cycle, and the risks to time frame, just unpredictable events goes up much more. Chinese developers have developed huge projects in a few years time frame. So the time frames and the scale just there's no comparison. From investors' perspective, I think they would like to take finite bets and they would like to take known risks. Again, I personally believe that there is capital available for all types of risks, provided they are known and quantifiable. So investors are a much smarter lot after the crisis, after the previous experiences. So I think they will be plugged into the local markets. And to Somi's point, they will debate everything in the business plan. They will not make any sort of unreasonable assumptions.
Wait for the capital to come, liquidity, when it hits, rationalization goes for a toss. So my sense is, while you may still have educated investors, there will be another set of investors who may come in.
Well,
I don't know the answer. But
I'm not sure, Sunil, because he spoke about Chinese developers, and as we see them coming in, they're a very sophisticated investor class. While they are developers, they appreciate the risks of emerging markets a lot better than maybe investors who came in from the US or Europe, a lot more rational in the expectations that they would like to make, and very, very long-term in nature. So, I don't think that we're going to see a repeat of what we saw 10 years back, hopefully and thankfully. Chinese and maybe followed suit by some Japanese interests will probably only strengthen, the investor maturity asset class. I think the whole thing is moving towards a lot more number of investors, a lot more number of credible development firms, more development track record. In 10 years back, if you looked at development track record for most developers in India, they were all starting out, they were new. But now you have this whole category of what we call Class A, Class B, purely based on track record, not corporate governance. And I feel it's making a difference.
Yeah, perhaps China experience can be implemented in some projects in India by Chinese, using Chinese capital, Chinese developers coming in, bringing in Chinese contractors or some of the international contractors, very scalable, good execution ability, also bring a lot more capital that works with their kind of risk profile and time frame. That is definitely not ruled out. But I think that the differentiating factor between townships then and townships now is going to be that they will seek to create significant job creation in the same township. And I think where we were not perhaps going very right in our earlier phase of thinking about townships was we were thinking of them as residential clusters. Perhaps they have to be developed around job concentrations. And that model can succeed in India. I mean, I see no reason why that cannot succeed in India.
I agree. Before we wrap up, a quick view on alternate sectors. At least we are seeing a lot of interest from warehousing and retail, other than affordable housing. And I think affordable housing will be a longer term story where people, like Ashish said, they'll have to understand what affordable housing means. To some it may mean 10 lakh homes. To most developers it may mean homes 25 to 35 lakh, but just smaller unit sizes, so that you're catering to a customer class which says, look, this is the budget that I can have, and by the way, I'm happy to live in a smaller home. And you've been building much bigger homes, which I can't afford for a very long time. All I need is an affordability index. But warehousing, we are seeing significant interest. Retail, selective interest, not that much on the greenfield side. But are there good returns to be made for investors we can get?
And I think absolutely. More than warehousing, you touched upon the point of student housing. Alternative investments, we recently saw an article about Manipal Evanston. Manipal student housing has been, chased by somebody from an investment perspective. So we actually seeing lot more interest from investors to look at alternative assets. So a student housing, a senior living, some of these concepts are now emerging. Warehousing, of course, we are seeing two things: consolidation that's already happening there. We never had a pan-India player. We have one pan-India player right now, and we are seeing more and more of such platforms coming into India right now. And they are creating whatever can be considered grade A warehouse, is being bought by somebody, and they're aggregating that in order from a tenant relationship perspective and a larger scale perspective. And I think with the e-commerce and the overall development of GST, mother warehouses concept will definitely come in. So these are fundamentally drivers which will change the mom and pop warehousing concept. So either some of them can take part in this journey by partnering with the developers who understands this in terms of scale. But that's definitely one space where we see a lot of action happening in the warehousing space.
I just want to add about warehousing. If I were to sum up warehousing in one sentence, I think warehousing sector in India is where office sector in India was in 2002, 2003 time. And that sort of is indicative of both the opportunities and challenges for that sector.
I would agree. I say that all the time to our clients. Bang on, Sarang.
I think one of the alternative sectors which has not come up in India as of now is rental housing. Now, rental housing makes a lot of sense in the developed cities because there are large investors who can put in money, and then it all works on yields. And again, the exit is, it becomes a REIT structure over the time, and the exit is through the capital appreciation. So this is like if I'm a retail investor, or say I'm a home buyer and I want to stay in the center of the city. Now, if I were to buy the apartments and I'm buying it for 2, 3, 4 crores, that market is drying up now. So what makes sense is for large developers, large institutional developers to come in and grab this opportunity where they can rent it out on yields, and over the time there's a capital appreciation to the property being in the center of the city or places like those. I think that is another alternative investment area that probably first the regulation has to be in place, and that's when the institutional investors have to come in.
Sunil, I'd like you to give a few closing remarks before we open for Q&A. Thank
Okay. So I think a couple of things on alternate assets. I see a lot of investment going into affordable housing because simply there's an interest rate subsidy. And so at a personal level, if you look at today the rate structure, 8.5%, if I can get that subsidy of 3 or 4%, it reduces to 5.5%. And then further, if I calculate tax concessions, it gets to about 2 to 3%. And that is, very much in striking range of what 1.5, 2% yields on assets are. So I think at an individual level, yes, rental housing probably will start making sense. But at the institutional level, I think it is still far away because of the regulations. On closing remarks, I think one thing that I would just like to sensitize audience, I don't know how many of you are aware, that we had a professor come into our institute 2 months back, and he told us what REITs are, and we're still trying to see what REITs would mean in Indian context. And can anybody in the audience guess what is the highest asset class? What is the highest yielding asset class in US at this point in time in terms of jails? So that's what it is. So, we are still far away. We don't think so. We should have jail as an asset class. Should have lesser number of criminals than what we have in the US, etc. But I think alternate asset classes in urban context could be parkings, could be schools, could be hospitals, could be a variety of other asset classes, which I think investor is becoming aware of. And I think on the HNI side, and Gaurav, you said absolutely the right thing. The local investors have a pulse of the market, and if you see, some of the sales that have happened in the logistics space, it's not the institutional investors, it's the HNIs that have come and bought large assets. I mean, I'm talking of investments from 60 to 120, 134, crores. And I think I'm very bullish about that, aspect. However, as a professor, as a professional from the industry, I do believe in one thing, that there are still going to be some people who are going to make mistakes. I still can't fathom out how people buy an asset for 8.5% yield when stock market post-tax return is 10%. So there are still going to be some mistakes, which probably, will give us to the third cycle, and we're going to say, okay, we'll correct that as well. So from my senses, if liquidity comes, it is the biggest danger. Today you're seeing stock market at 2022, and biggest of the pundits are saying we are in for a long term. 2022p is good for India. I don't know whether this is another story where in November you will see everybody will go on holidays and you will crash to 16, and that will be another time when people say now invest, it is at 16. So I think this thing will go on, but I think overall a great market to be in, regulated market. I said last session also, regulation is going to increase the size and the scale of players, and therefore is going to get much bigger in terms of opportunity.
Thank you for ending on a positive note, Sunil. Maybe we have time for one or two questions only. We are running short of time. So if there are any, otherwise we can wrap up for lunch. Great, super. Thank you. Thank you. Thank you, everyone. Pleasure.
Thank you, gentlemen, for sharing your thoughts and views with us. May I request Mr. Gaurav Kumar to please present mementos to our panelists. To begin with, Mr. Sarang Kulkarni, Mr. Sunil Agarwal, Mr. Ashish Singh, and Mr. Somi Thomas. May I request Mr. Agarwal to present a memento to our moderator, Mr. Gaurav Kumar. Thank you very much, gentlemen. That was the most interesting 1 hour.